Investment is crucial for several reasons, whether you're an individual, a business, or a government. Understanding why investment is important can help you make informed decisions about your finances and future. Here's a breakdown of why investment is so vital. 1. Wealth building and financial security. Investing is one of the most effective ways to build wealth over time. Unlike simply saving money in a bank account, investments can grow significantly through compound interest, dividends, or appreciation in value. Over time, this growth can lead to substantial financial security, providing you with a comfortable lifestyle and the means to achieve your long-term goals, such as buying a home, funding education, or retiring comfortably. 2. Beating inflation. Inflation erodes the purchasing power of money over time. If your money is just sitting in a savings account earning minimal interest, it's likely losing value every year due to inflation. Investments, particularly assets like stocks, real estate, or bonds, typically offer returns that outpace inflation, helping you maintain or even increase your purchasing power. 3. Achieving financial goals. Whether you're saving for a down payment on a house, funding your child's education, or planning for retirement, investing can help you reach these financial goals faster. By strategically allocating your money into various investment vehicles, you can potentially earn higher returns than you would with traditional savings, bringing your financial goals within reach sooner. 4. Diversification and risk management. Investing allows you to diversify your portfolio across different asset classes, like stocks, bonds, real estate, etc., industries, and geographic locations. This diversification helps spread risk, so if one investment underperforms, others in your portfolio may perform well, balancing out your overall returns. Diversification is a key strategy in managing investment risk. 5. Passive income generation. Certain investments, such as dividend-paying stocks, bonds, or rental properties, can generate passive income. This means you can earn money without actively working for it, providing additional cash flow that can supplement your primary income, fund your lifestyle, or be reinvested for further growth. 6. Economic growth and innovation. On a broader scale, investments drive economic growth and innovation. When you invest in companies, you provide them with the capital needed to expand operations, develop new products, and create jobs. This growth benefits not only the investors but also the economy as a whole, leading to a healthier and more dynamic business environment. 7. Retirement planning. Investing is essential for retirement planning. Government pensions and social security may not be sufficient to maintain your desired lifestyle in retirement. By investing in retirement accounts like 401(k)s or IRAs, you can take advantage of tax benefits and the power of compound interest to build a nest egg that will support you in your later years. 8. Financial independence. Investing wisely can lead to financial independence, where you have enough assets and income to cover your living expenses without relying on a job. This independence gives you the freedom to pursue your passions, travel, or spend time with loved ones without financial stress. 9. Contributing to societal progress. Investing in socially responsible companies or projects can contribute to societal progress. By putting your money into businesses that align with your values, such as those focusing on sustainability, clean energy, or social equity, you can support initiatives that aim to make the world a better place. 10. Building a legacy. For many, investing is about more than just personal gain. It's also about building a legacy for future generations. Through investments, you can create wealth that can be passed down to your children or grandchildren, providing them with opportunities and financial security. When it comes to building a solid financial future, understanding the types of investments available is crucial. Not all investments are created equal, and knowing which ones align with your financial goals, risk tolerance, and timeline is key to maximizing your returns and securing your financial well-being. Understanding stocks. The backbone of most portfolios, stocks represent ownership in a company. When you purchase a share of stock, you're essentially buying a small piece of that company. Stocks have historically offered higher returns compared to other asset classes, but they also come with higher volatility. Investing in stocks requires a long-term perspective, as the market can fluctuate significantly in the short term. However, over time, stocks tend to grow in value, making them a foundational element of most investment portfolios. Bonds. Stability and predictable income bonds are debt securities issued by governments or corporations. When you buy a bond, you're lending money to the issuer in exchange for regular interest payments over a specified period, along with the return of the bond's face value when it matures. Bonds are generally considered less risky than stocks and are often used to balance out the volatility in an investment portfolio. While they offer lower returns, they provide stability and a predictable income stream. Real estate. Tangible assets with growth potential. Investing in real estate involves purchasing property with the expectation that its value will increase over time. This can include residential, commercial, or rental properties. Real estate investments offer a tangible asset that can generate income through rent while also appreciating in value. Moreover, real estate tends to perform well during inflationary periods, as property values and rental income typically rise with inflation. Mutual funds and ETFs. Diversification made easy. Mutual funds and exchange-traded funds, ETFs, pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. This allows individual investors to achieve diversification without having to buy each security individually. Mutual funds are actively managed, meaning a fund manager selects the investments, while ETFs typically track an index and are passively managed. Both options provide a relatively low-cost way to diversify your investments and reduce risk. Cryptocurrency. High-risk, high-reward cryptocurrencies like Bitcoin and Ethereum have gained popularity as alternative investments. They are digital or virtual currencies that use cryptography for security. Cryptocurrencies are highly speculative and volatile, with prices that can swing dramatically in a short period. While they offer the potential for high returns, they also come with significant risk. It's crucial to approach cryptocurrency investments with caution and only allocate a small portion of your portfolio to this asset class if it aligns with your risk tolerance. Commodities. Protecting against inflation. Commodities include physical assets like gold, silver, oil, and agricultural products. Investing in commodities can be a way to hedge against inflation, as their prices often rise when inflation increases. Commodities are typically considered a more volatile investment, as their prices can be affected by various factors, including supply and demand, geopolitical events, and changes in the global economy. However, they can offer diversification benefits when added to a broader investment portfolio. Savings accounts and CDs, safe but low yielding for those who prioritize safety over returns. Savings accounts and certificates of deposit, CDs, are the go-to options. These accounts are insured by the government, making them one of the safest places to store your money. However, the returns are relatively low, and they may not keep up with inflation over the long term. CDs lock your money away for a fixed period in exchange for a slightly higher interest rate, making them suitable for short-term savings goals. Robo-advisors, automated investing for the tech-savvy. Robo-advisors are online platforms that use algorithms to manage your investments. They offer a hands-off approach to investing, providing diversified portfolios based on your risk tolerance and financial goals. Robo-advisors typically charge lower fees than traditional financial advisors, making them an attractive option for those who prefer a tech-driven, low-cost investment strategy. Diversification, the key to risk management. No single investment is without risk, which is why diversification is so important. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the impact of any one investment's poor performance on your overall portfolio. Diversification is often described as the only free lunch in investing because it allows you to manage risk without sacrificing potential returns. Long-term perspective, weathering market volatility. One of the most important principles of investing is maintaining a long-term perspective. Markets will always experience ups and downs, but reacting to short-term volatility can lead to poor investment decisions. By focusing on your long-term goals and staying invested through market fluctuations, you increase your chances of achieving solid returns over time. Once you've laid the groundwork by understanding different types of investments and their roles in your financial plan, the next step is to create a strategy that aligns with your specific goals and circumstances. A well-defined investment strategy is essential to navigating the complexities of the financial markets and maximizing your potential for growth. Setting clear financial goals. The first step in developing a successful investment strategy is to define your financial goals. Are you investing for retirement, a down payment on a home, your child's education, or another significant life event? Your goals will determine the time horizon for your investments and help you decide the appropriate level of risk. For example, if you're saving for a retirement that's 30 years away, you might be willing to take on more risk compared to someone who is saving for a short-term goal like buying a house in the next few years. Risk tolerance. Know your comfort level. Understanding your risk tolerance is crucial in deciding where and how to invest. Risk tolerance refers to your ability and willingness to lose some or all of your original investment in exchange for potential higher returns. If you're comfortable with the idea of your investment fluctuating in value and possibly experiencing significant losses in the short term, you might have a high risk tolerance and can consider more aggressive investments like stocks or cryptocurrencies. Conversely, if you prefer stability and low risk, you might lean towards bonds, real estate, or a more conservative portfolio. Asset allocation. Balancing risk and reward. Asset allocation is the process of dividing your investment portfolio among different asset categories, such as stocks, bonds, real estate, and cash. The goal is to balance risk and reward by apportioning your portfolio's assets according to your risk tolerance, financial goals, and investment time horizon. A common approach to asset allocation is to invest a higher percentage in stocks when you're younger, then gradually shift towards bonds and other more stable investments as you approach retirement. This strategy leverages the growth potential of stocks while reducing risk as your need for stable income increases. Diversification. Spreading out your investments. While asset allocation is about choosing the right mix of investments, diversification is about spreading your investments across different sectors, industries, and geographies to reduce risk. Even within a particular asset class, such as stocks, you can diversify by investing in various industries like technology, healthcare, and consumer goods, or by including both domestic and international companies in your portfolio. Diversification helps protect your portfolio against significant losses, as different assets tend to perform differently under varying market conditions. Regular monitoring and rebalancing investment strategies are not static, they require regular monitoring and adjustments to ensure they remain aligned with your goals and risk tolerance. As markets move and certain investments perform better or worse than others, your portfolio's allocation might drift away from your target. Rebalancing involves buying or selling assets to return your portfolio to its original allocation. For example, if stocks have performed well and now make up a larger portion of your portfolio than intended, you might sell some stocks and buy bonds or other assets to restore balance. Tax efficiency. Maximizing returns. Taxes can significantly impact your investment returns, so it's essential to consider tax efficiency in your strategy. This involves choosing the right investment accounts, such as retirement accounts, 401(k)s, IRAs, that offer tax benefits, and strategically placing investments in taxable versus tax-advantaged accounts. For example, placing high-growth investments like stocks in tax-advantaged accounts can help defer or avoid taxes on gains, while holding bonds or dividend-paying stocks in taxable accounts might generate more current income, subject to taxes. Understanding how to minimize taxes on your investments can increase your overall returns. Staying the course. Avoiding emotional decisions. One of the biggest challenges investors face is managing emotions. Market volatility can tempt investors to make impulsive decisions, such as selling off investments during a downturn or chasing high-performing assets after they've already peaked. However, reacting emotionally to short-term market movements can undermine your long-term strategy. It's essential to stay disciplined and adhere to your investment plan, even when markets are turbulent. This might involve having a predetermined set of rules for when to buy or sell investments, or working with a financial advisor to help keep your emotions in check. Continuous learning. Stay informed. The investment landscape is constantly evolving, with new opportunities, risks, and financial products emerging regularly. Staying informed about market trends, economic developments, and new investment strategies is crucial for maintaining a successful investment strategy. This doesn't mean you need to react to every piece of news, but rather that you should keep learning and adapting your strategy as necessary. Consider reading financial news, attending seminars, or consulting with investment professionals to stay ahead of the curve. Investing is a journey that requires careful planning, patience, and discipline. By setting clear financial goals, understanding your risk tolerance, and developing a well-balanced investment strategy, you can navigate the complexities of the financial markets and work towards achieving your long-term objectives. Remember that investing is not about quick wins but about building wealth steadily over time. Stay focused on your goals, keep learning, and be prepared to adjust your strategy as needed to stay on track. Don't forget to subscribe in the channel and like the video for more contents.